The first thing I would say is it's not gold and silver going up so much. I mean, there is an element of that. You can't disentangle it, but it's basically paper currencies going down. This is actually what the central banks see. The reason that central banks are buying gold is that they're actually selling fiat. And, that is a very important point to understand. Ultimately, when everybody understands that it's fiat going down and not prices rising, and we're not just talking gold at this stage, but we're also talking about, groceries and everything else, then the currency's doomed. So we are on the beginning of that curve, well, in fact, we were on the beginning of that from 1971, when we started in 71 with $35 an ounce, and we're now close to 3,000. But obviously, the way people think, they're not thinking like so. They're trading it as if it was a stock or whatever, I would personally think that 3,000, there could be some consolidation around about that 3,000 level. It's a view. I wouldn't sell on the basis that it's going to, it's going to consolidate and it might tip back and you might be able to do this, that, and the other. Why? Because if I sell gold, I'm buying dollars. I don't want to buy dollars. For goodness sake, I want to get the hell out of them. And as far as silver is concerned, I think with the gold-silver ratio close to 90, that to my mind is far, far too high. Silver does have a monetary role. There is absolutely nothing in the price for a monetary role at the moment. But I think when you get the collapse of currencies, silver has got two advantages. Firstly, it's, somebody said it's the poor man's gold. I think that's actually, a sort of a reasonable description for the role of silver in terms of being useful for smaller transactions. If you think that the politicians might try and ban ownership of gold, and politicians are stupid, let's face it, when it comes to economics, they are on a completely different agenda. But then you ask the question, okay, if they ban ownership of gold, are they likely to do so with silver? And I think the answer is no, because it's not regarded as a monetary metal anymore. So on that basis, there is some justification for going for silver. And my view is that, traditionally, when you get a rise in the price of gold, silver tends to rise about twice as far. The problem with silver is that when gold stops rising, it falls, probably not only twice as fast, but it keeps on falling when gold goes nowhere. So that's the sort of problem you've got with silver. But having said that, it's got left way, way behind. And we've had, particularly if you ignore the, selling of ETFs about 5 years ago, silver ETFs, we've had about 7 years of supply deficiency. That's according to the Silver Institute's number. And I think it's also been a very managed commodity. I point the finger at China for managing the silver price, whether I'm right or wrong, I have no doubt that it has been very, very suppressed, and on that basis I think the suppression has probably come to an end.
The global financial system is experiencing a fundamental shift, one that many investors have yet to fully grasp. The discussion surrounding gold and silver is no longer just about their rising prices, but rather about the devaluation of fiat currencies. When central banks engage in excessive money printing and reckless monetary expansion, the real impact is not necessarily that gold and silver are appreciating, but that paper currencies are losing value. This distinction is crucial because it underscores the inherent weakness in the current economic model, one built upon credit expansion and currency debasement, rather than genuine productivity and sound money principles. The core reason behind central banks' aggressive accumulation of gold is not speculation or hedging against temporary inflationary trends. Instead, they are actively offloading fiat currency reserves in favor of hard assets. This strategic move signals a loss of confidence in the purchasing power of government-issued money. It is not merely a shift in central bank policies, but rather an acknowledgement that fiat currencies are in long-term decline. Since 1971, when the world fully abandoned the gold standard, the purchasing power of the US dollar has plummeted. Gold, which was once valued at $35 an ounce, is now approaching $3,000. However, this is not a reflection of gold's rising worth, but rather a measure of the dollar's diminishing strength. This trend extends beyond just gold. Silver has historically been undervalued, and the current gold-to-silver ratio, hovering around 90-1, suggests that silver remains significantly suppressed. Traditionally, this ratio has averaged closer to 50 to 1, which means that silver should be trading at much higher levels relative to gold. This makes silver an attractive investment, particularly for those who are priced out of gold or those seeking greater upside potential. Unlike gold, which is largely seen as a monetary asset, silver has extensive industrial applications, making its demand dynamics even more compelling. The surge in industries such as solar energy, electric vehicles, and high-tech electronics is driving silver consumption higher, while mining output struggles to keep up. However, what investors often fail to recognize is the extent to which governments and financial institutions have manipulated these markets. There is growing evidence to suggest that silver, in particular, has been artificially suppressed, with major players such as China possibly engaging in strategic price control to accumulate reserves at low prices. This type of intervention distorts natural supply and demand forces, keeping silver undervalued for prolonged periods. But just like any artificial market suppression, it eventually collapses under its own weight, leading to a rapid repricing of assets once control mechanisms fail. The same can be said for gold, where large institutions and central banks hold significant short positions to keep prices artificially lower. However, these positions are increasingly difficult to maintain as investors worldwide begin demanding physical delivery of metal rather than paper claims. In recent months, a significant shift has been observed in the behavior of bullion banks, financial institutions that traditionally act as intermediaries in the precious metals market. Many of these banks have been closing out their short positions, indicating that they anticipate higher prices ahead. This suggests that a short squeeze is imminent, where the unwinding of short positions forces a surge in prices. A sharp increase in gold to $3,000 or beyond could lead to a panic among bullion traders, particularly those still holding excessive short positions. As this unfolds, silver, which typically moves at twice the pace of gold, could see even more explosive price action. For investors, the key takeaway is clear. Gold and silver remain the most reliable stores of value in a declining fiat currency environment. However, the strategy for investing in these assets matters greatly. Holding physical bullion rather than exchange-traded funds, ETFs, or paper derivatives is essential, as it eliminates the counterparty risk associated with financial institutions. In times of crisis, when the demand for physical metal outstrips supply, paper contracts may become worthless if there is no actual metal available for redemption. The broader implications of this financial transition are profound. As more investors and institutions realize that fiat money can be printed indefinitely, but gold and silver cannot, we will likely witness an accelerated movement away from traditional currency holdings. Countries that have historically relied on US dollars as foreign reserves are already diversifying into gold, reducing their dependence on dollar-based trade. This is part of a larger global trend of de-dollarization, where nations seek alternative financial systems that are less vulnerable to inflation and currency depreciation. As the world moves closer to a full-blown monetary reset, the urgency to secure tangible assets is greater than ever. Investors who delay their move into gold and silver may find themselves unable to acquire these metals at reasonable prices once the market wakes up to the reality of fiat currency debasement. This is not merely about inflation, it is about the structural failure of the current financial system. Paper money is losing trust, and when that trust is fully eroded, gold and silver will be the last asset standing. Those who act now will be in a position to protect their wealth and capitalize on one of the biggest monetary transitions in modern history.
And I also think that the bullion banks, they're desperate to try and bring their shorts in. I mean, it's interesting, and I think to some extent the sudden premiums that we saw on COMEX, and we saw the price rise something like $200 while open interest fell 75,000 contracts. I mean, that's the best. And who are the bears? The bears are the established. They are being squeezed, and I think they want out of this short position. So that is another factor which is likely to really affect the price. And if we get up to that sort of $3,000 level, then there could be some panicking on the short side, as it were, because it's not really the longs who have been buying futures too much. I mean, I think it's It's shifted a little bit because I see open interest on COMEX has risen to just close to 500,000 contracts. I mean, that's not overbought by any means. And we could go another 100,000 contracts to the 600,000 contract level before you say this market is overbought. I think there's quite a lot of bear squeeze potential still in there. And 3,000 could be a Rubicon, I think, for quite a lot of the bullion bank traders. Interesting position. And we're now in a recession. If we have another quarter like that, it's going to be a technical recession or an official recession. But I mean, they're only saying half the story, Danny, because if you take the budget deficit, which is roughly 6.5% of GDP, out of GDP, you're then left with the private sector. And on the Congressional Budget Office's own figures, total GDP, they expect in this current year to be growing at 4.5%. So on their figures, the private sector is already contracting by 2%. And that's in nominal terms. And then if you put in inflation adjusted or just CPI adjusted, let's not use any sort of fancy numbers, just the official numbers, then quite clearly it's contracting at the rate of about 5%. Now that, by any definition, is sort of verging on a slump. That is the background to it. And I think investors are beginning to get sort of concerned that this indeed is the case. I mean, they've ignored it so far. They've ignored it because of greed. I mean, you got all this credit,
right?
$1 trillion of leverage in the U.S. stock market, and the bulk of that, I guess, we don't know for certain, but the bulk of that, I guess, was sort of chasing fancy tech stock. So, this bubble, when it bursts, I think could be rather nasty. And the other point I would make about it is that not only do we have a mega credit bubble bursting, we also have Smoot-Hawley Mark II tariffs being brought in by Trump. And already you see, the new prime minister in Canada saying, we're going to hit back with our own tariffs and all the rest of it. We've got exactly the same combination, but this time it's actually a lot more violent. This is not good.
The global financial system is approaching a critical tipping point, one where fiat currencies are steadily losing their purchasing power. Unlike previous financial crises that were localized to specific regions, today's monetary instability is a worldwide phenomenon. Governments have aggressively expanded their money supply in response to economic slowdowns, banking collapses, and geopolitical instability, but they have done so at the cost of the integrity of their own currencies. This is why gold and silver have become increasingly relevant, not because they are rising in value, but because fiat currencies are declining at an alarming rate. While central banks and institutional investors are quietly increasing their holdings of real assets, everyday people are only just beginning to wake up to the reality that their savings are being systematically devalued. For decades, the global economy has functioned on an unbacked fiat currency system, one in which governments could print money with no direct tie to real assets. This has enabled an era of unprecedented credit expansion, but it has also sown the seeds of economic instability. The current economic crisis is not merely a cyclical downturn, but a structural failure of the monetary system itself. Inflation, which governments have tried to downplay as transitory, has now become a persistent force, eating away at the real earnings of workers and the value of long-term investments. The more money that is printed, the less each unit of currency is worth. The illusion of economic stability has been propped up by cheap debt. But now that interest rates are rising, the cracks in the system are impossible to ignore. One of the most telling signs of a collapsing fiat system is the growing demand for gold among central banks. Historically, central banks have downplayed the importance of gold, dismissing it as a barbarous relic in favor of modern financial instruments. However, their actions contradict their words. In recent years, they have been aggressively accumulating gold, reducing their exposure to US dollars, and increasing their reserves of tangible assets. This is not speculation. It is preparation for a world where gold may once again play a central role in the global monetary system. China and Russia in particular have been leading this trend, steadily diversifying away from dollar-based assets and increasing their gold holdings as a hedge against Western financial instability. The possibility of a formal gold revaluation is becoming more likely as fiat currencies continue to lose credibility. If central banks are forced to stabilize their economies in the wake of a major financial crisis, They may reset the value of gold at a much higher level to restore confidence in their monetary systems. This would not be an acknowledgement that gold is suddenly more valuable, but rather a recognition that fiat currencies have lost their credibility. Historically, this has happened before, most notably in 1933 when the U.S. government revalued gold from $20 to $35 per ounce, effectively devaluing the dollar overnight. A similar move today could see gold priced at $10,000 per ounce or higher as part of a broader monetary reset. While gold is expected to play a major role in any future financial system, silver remains one of the most underappreciated assets in today's market. Unlike gold, which is primarily held for monetary purposes, silver is both a monetary metal and an industrial commodity. It is an essential component in solar panels, electric vehicles, medical technology, and high-end electronics. With the global push toward renewable energy and digital infrastructure, demand for silver is projected to surge beyond available supply in the coming years. However, what makes silver particularly compelling is that it has lagged behind gold in price appreciation, meaning that it is significantly undervalued relative to its historical performance. The gold-to-silver ratio currently sits at around 90-1, meaning that it takes 90 ounces of silver to equal the value of 1 ounce of gold. Historically, this ratio has been much lower, often closer to 50-1 or even 30-1 during bull markets. If silver were to return to these historical ratios, its price would double or even triple from current levels. This suggests that silver may have far greater upside potential than gold, especially in an environment where inflation continues to erode the purchasing power of fiat money. Beyond investment fundamentals, silver also presents a strategic advantage in times of government intervention. Throughout history, governments facing economic crises have restricted or taxed gold ownership as a means of controlling capital flows. In 1933, the U.S. government enacted Executive Order 6102, which effectively outlawed private gold ownership and forced citizens to turn in their gold holdings to the Federal Reserve. While a similar move today would be more difficult to implement, it is not outside the realm of possibility. Silver, on the other hand, is less likely to face such restrictions, as it is not widely regarded as a monetary asset in the same way gold is. This makes silver an attractive alternative for those looking to preserve their wealth without attracting government scrutiny. Another major factor driving silver demand is the ongoing supply deficit. Unlike gold, which is mostly stored and retained, silver is often consumed in industrial applications and not easily recovered. For the past 7 years, global silver demand has outpaced production, leading to supply shortages that have yet to be reflected in market prices. The Silver Institute has repeatedly reported supply deficits, indicating that future shortages could cause silver prices to spike dramatically. Once industrial buyers begin facing difficulties securing enough silver to meet their production needs, the market could experience a historic price surge similar to what was seen in past silver bull markets. The broader implication of this financial shift is clear. Gold and silver are not merely hedges against inflation, but essential stores of value in a world where fiat currencies are failing. Investors who recognize this early have the opportunity to protect their wealth and position themselves for enormous gains as the financial system undergoes a historic transformation. However, the time to act is before the crisis becomes fully apparent. Once the collapse of fiat confidence is widely acknowledged, gold and silver prices will no longer be available at current levels, and obtaining physical bullion will become significantly more difficult. For those looking to prepare, the most important step is to own physical gold and silver rather than relying on paper-based investment vehicles such as ETFs or futures contracts. Physical metal eliminates counterparty risk and ensures that your wealth is not tied to the solvency of financial institutions. Additionally, diversifying storage locations, such as keeping bullion in private vaults outside the banking system, provides an added layer of security in the event of government intervention or capital controls. The future of the global financial system is uncertain, but one thing is clear. Fiat currencies are losing their value, and gold and silver are regaining their place as real money. The collapse of the current monetary order will be a defining event of this century, and those who prepare now will be among the few who emerge with their financial stability intact. As the Great Reset unfolds, the choice is simple. cling to a failing fiat system, or move toward assets that have stood the test of time. The window of opportunity is closing, and those who act now will be the ones who control real wealth in the new financial era.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.